When it comes to investing, small companies are usually considered higher risks because of the uncertain nature of their investment. On the flip side, these types of investment could potentially yield much higher returns if you choose the right company. So today we're going to look at risk and rewards or pro and cons of HIMS and HERS Health, ticker symbol HIMS. I've prepared a few items, and I would say let's just get straight into it. And I'm going to tell you, I'm going to start off with the cons that I found for me personally, and then I'll flip over to the pros. And in the end, I'm going to tell you whether I've personally been invested in it at the moment, and where I see this stock is going for the next year, and then potentially for the next 5 years, what my sort of investment thesis or expectation is. So yeah, let's jump right into it. The first con I really have is it is a young business. It's only been established a few years ago, and it's only recently been listed since 2021. And they definitely are a young business, and for that reason they're unproven. So they haven't really stood the test of time to see if they can handle, any kind of challenge that comes their way. So this is my first con for that. And because of their young and unproven, customer retention is a big question mark for me. Because obviously HIMS and HERS Health, they are sort of providing healthcare services and healthcare products to mostly sort of younger people, millennials or Gen Z. So they would go on the app, talk to a doctor, and then get a sort of subscription for whatever health concern they have, which is usually to do with sexual or mental health. So as such, the business model is nice, but the question is, because we don't have that history to look back to, will they actually retain those customers once they've got them on the subscription model for those type of hair products or skin products, or will those customers just be short-lived? So the sort of the customer lifetime value of a customer, that's really a question mark at this stage. If I go back to the next one, what I've seen so far is that although they have really high margins, in order to get to the new customers, they have to spend a lot of money on marketing expense. So we can see that here that over the past few quarters, revenue has been increasing rapidly, but as such has also the marketing expense, which just has been exploding, which is the key reason, plus selling and marketing expenses. Those are the key reasons why the business is making a loss at the moment. So the question is whether the marketing expense that they have can actually acquire enough customers that will retain in the business so that they in future can lower those marketing expenses. So because otherwise they're never going to become profitable. They always have to keep up with that marketing budget and that selling budget. So the question here is really about customer retention and also the brand, the perception of the brand value or brand creation over the long term, which obviously if you have a known brand out there, you need less and less marketing expense to actually get it out there. But for the moment, I don't really see it as a big con, as I mentioned, they're a pretty young business, so you would expect that they have to actually raise that type of money, spend that type of money on to really get their name out there and to acquire new customers. But it's definitely something we should look out for. So in the upcoming quarters, I want to see that either decrease, or like as soon as the revenue increase is flattening down or it's decreasing, I want to see marketing costs decreasing as well. The healthcare market or the healthcare product market is a highly competitive market. So as you know, there's countless sort of products at the market and in the supermarket if you want to go. And they're all well-established brands and huge companies, very profitable companies. So there is a risk here that not only they take market share from HIMS and HERS, or the real risk here is actually that they might take over that business model and apply it, because what stands out for HIMS and Hers right now is that they're basically having this, new generational solution that you can call to the, talk to a doctor via the phone. You don't have to really go and make that uncomfortable appointment with your doctor to talk about like your sexual health issues. You can really have that, you answer a questionnaire, you go into a live chat with a doctor, and then you get your product sent to your home. So it's the convenience factor, but also the digital aspect to it. That's the new thing about it. So there is a risk that well-established companies and brands are just simply taking on that business model. We haven't really seen that yet, so that's a sort of a benefit at the moment for HIMS, for sort of first mover advantage. But going forward, there's a potential threat. I think that's all for my cons at the moment. So yeah, moving on to the pros, which are more exciting, I guess. So first of all, looking at the income statement, what I want to see here, despite the high marketing expense, revenue growth is just phenomenal at the moment. So we're looking at a 80% growth 3 months last year to 3 months in 2021, which definitely the pandemic had some sort of impact on that, as people stayed home a lot and they became more and more open to use that telehealth solution. But I think HIMS is a bit more special, that if you compare it to something like a teledoc, where it's your healthcare, your general healthcare and your health issues that you would manage for teledoc. With HIMS, it's more like it's meant to be digitally, as it's about uncomfortable topics that you might not even bring up, even if you go to your doctor in real life. So that it's meant to be more digitalized, so it doesn't really have to do with the adoption of telehealth solutions as such. I think it's more like something that millennials or Gen Z would anyways rather do via the phone, rather than going to their doctor. Yeah. And what I also really like about it is it seems to be very high margin. So I don't think they make much money off the actual doctor appointments. It's more like an Uber type system, where you get a practitioner and you talk to them, and you basically just give the majority of the money to them. It's more, the revenue is really coming from the high margin products that then they're gonna once they had that consultation, they're gonna give you that subscription, and you're gonna pay on a monthly basis, so that the cost of the customer acquisition cost over time decreases, and the products itself obviously generate a lot of good margin here. So we have 74% gross margin at the moment. So at that stage where they can lower those marketing and selling expenses, you can see a lot of profit or potential profit at the bottom line, which is what is so exciting about this company, I think. Moving on to the next one. So yeah, that ties into what I said earlier. So that subscription-based model is really what's the preferred model for a lot of businesses. We even see Taco Bell right now testing out subscription models for their tacos. So it seems like companies want to move to that subscription model to generate that predictable income that is always, that's retained, and basically you just add to it. So as long as your customers are happy with that product, you acquire a new customer who would get a new subscription, and so on, right? And then you don't have to acquire over and over again. Once they're happy with your product, they will always, keep that subscription running, or cancel it, but then later come back, similar to something like Netflix or something like that. So it is a good model, as your customer acquisition costs go down over the time. The next one is I've done a lot of research on sort of the products and how they actually been perceived by the customers. So reviews are really good, and I've seen a lot of sort of YouTube videos on transformation videos, like so I've seen that, and then also the reason why they have such high marketing expense, because they have people like Miley Cyrus endorsing the product and really getting it out there on the Instagram and whatnot. So that's really helping the brand, brand value creation, and I think it's a positive, and I think ultimately, no matter how good your business is, it is really depending on what is your product and is it liked by everyone. Like everyone loves Apple products, and this is ultimately the reason why they succeeded. It's not, looking at a few numbers here and there. It is really the product that is so important. Yeah, moving on to the next one. So I've had a look into the actual filings on the HIMS website, and I've seen there's a lot of insider buying recently, and I've looked into the people that who are these people who are actually insider buying, and some of the VC companies that actually supporting HIMS and hers. So recently been up, buying a lot of stock at those low level prices is one company called IVP, and I've done a little bit more research about them. And Jules Maltz, he owns over 10% of the company, and they had some really successful investments in their portfolio. So anyone would know Slack, that has been now bought by Salesforce in the end. So that was quite a good one. Another fintech, Wise, which I'm also invested in. So I really like their portfolio. So it seems like, judging by those other companies, you can see that they would not invest in something that they don't think is really good value. And I agree with what they perceive as being as of good value, looking at these other these other companies that they've already invested in. So that was really positive to see for me that they believe and support HIMS and hers. And also judging by their portfolio, it seems like they perceive HIMS and hers more as a digital online play, disruptive play, rather than just some sort of healthcare product provider, which, yeah, it makes sense. Yeah, the next one is really going back into that fact that we have that disruption here. So we're not just another healthcare product provider that will be in the shelf in some sort of supermarket. We have that disruptive business model, which obviously appeals to a lot of millennials and Gen Z. And millennials and Gen Z, they're going to be going forward the ones spending the most money. They are most open to use that digital channel as their digital natives, basically. So it's a good business model. And obviously, COVID has brought forward a lot of demand for that telehealth business model, which, judging by people like Kathy Wood, is not going to go away just because of COVID. It's not like, oh, that's been just a trend during COVID and then it's been going away. It's like working from home. Like it's going back to the office to some degree, but more in a hybrid model. So you have brought forward that revolution as such a few years just by having COVID happening. So there's definitely a massive total addressable market for this new type of health. I mean, I was listening to some podcasts of Kathy Wood, and she was talking about trillions basically of dollars. So if HIMS and hers can position themselves in this nice niche market, then they might have a good chance of establishing themselves as a known brand on which is sort of my last bullet point here. So they're not going after sort of all health products and competing with the largest companies, which was a con on my side here. They are actually choosing that niche market of sexual health, mental health, which is really relevant these days, especially for younger people. And they're really open to it, and they want to help themselves and help others about it. So it is really good to see that they're going after this kind of a niche market and really trying to be that brand for him and her in that type of market segment. So I feel I really like that, because I think that's how you become sort of they're trying to build a monopoly in that niche market, and then basically from going from there and add on, similarly to some sort of Amazon, right? They become the niche monopoly player in online book sales, while they will keep adding products to it. So I can see Hims and Hers doing sort of a similar thing, that they would become the number one sexual health, product provider. And then going forward, they would add to it, they would add, psychology related stuff or mental health or whatever it is, that is kind of suitable to this type of market, but it's a little bit different, and then expands their total addressable market even further. So yeah, those are my pros and cons. One thing I haven't actually mentioned, which I just realized, is yeah, just in terms of valuation. I mean, we look at that stock, and it's been trading down for ever since it's really been going public. So let's quickly go to the graph here. So it's been it was a SPAC before, so just a holding company, so trading at $10. Then the SPAC was announced with Hims and Hers. That was right in the euphoria of the February 2021 growth market. Stock price jumped to $24. Since then, all sort of growth-related companies really been going down. So the $24 turned into $5. So it's really unlucky if you were investing in right in the beginning of the IPO. Yeah, so it's been going down, down, down. When you look at the actual ratios that we have at the moment for this, so for high growth, 80% revenue growth company, we have currently a price to sales ratio of 3. So I think this is something you also have to look at it from a risk reward perspective, right? This is a high growth company, and we don't really expect them to, lower their growth anytime soon, as they've just been starting out. So how can they have a 3 times sales price tag? So this is just, I think, ridiculous from my side. They should really have a little bit more elevated level. Anything up to 10, I would see as reasonable. Like if it was a 5 or 6, and just simply a 6 price sales ratio would mean that this stock should be trading at something around $10, and would be a double up from here. So in terms of my estimate for the next year, or for this upcoming year, I do think that if Hims and Hers has been caught in this little bit of a downtrend of all the growth stocks with inflation fears and with interest rate hike announcements. So I think it's been caught into that type of loss-making small and young business. So seen as just really high risk, high risk, high risk. And that's been caught in that, traction. So I think that's why it's been going down. So it's a bit unjustified, because we actually had so many good news coming out. They were going into Walgreens. They've been going into Amazon, selling there. So we just had really positive news after the other coming out, and the stock has been trending down because of macro trends. So as long as the macro trends are some sort of calming down or reversing, so let's say interest rates are done in the first half of the year, and then nothing else happens basically, then I do see a really strong return potential for this year. I wouldn't be, surprised if this is going up to $10 by the end of the year, if that fear in the overall market has subsided a little bit. But obviously, you never know what's happening. It could be trending for $4 next week, and then maybe not come up for 1 or 2 years. But I don't think it's justifiable if they keep pushing out good numbers, and especially around earnings season, when we have those numbers, then we might see some more optimism around it. If interest rates are not that hot of a topic anymore, and they publish good numbers, then those type of stocks with 1 billion market cap only, they can turn around very quickly, because it only takes so little capital in comparison to something like an Amazon, which has $1 trillion market cap. It really takes a little bit of capital, a little bit for institutions to turn this around to a $10 stock quite easily. So I think this is what we can expect for this year, potentially a double up, if everything goes well. Definitely outperforming the S&P, I would think so. And on the long run, I mean, if they keep executing, and if what we said is becoming true, so they lower these high expenses here we can see a huge, net margin in the end and the bottom line here, which with that revenue growth, that margin, and then, increasing net profit, could put them at an easy $5 to $10 billion market cap valuation. So this would mean it's a 5 to 10x over the next 5 years if management keeps executing, if they can really establish themselves as a brand. So so there's a huge potential here. So if I summarize all of that, there's definitely significant risks you have to consider, and there is a reason why this is not trading at at 10x or price to sales ratio of 10, because there are risks to it and they are loss making at the moment. But you really have to consider that, from a growth perspective, they're on point. Risk of bankruptcy is very low. There's almost no long-term liabilities. They have a good, strong current asset position. So from that perspective, is low risk of a bankruptcy, but there is potential risk that the market segment stays negative, the stock keeps being beaten down, and then really that there's no sort of quick turnaround. So I wouldn't sort of expect a quick turnaround anytime soon. I mean, anything that will give you a 5 to 10x return in the next 5 years, you really just have to be patient and really make your bet based on what you can afford to lose or what you can afford to wait on until you get that return. So yeah, obviously this is just for entertainment purposes. Anyone has to know what they're doing. I've recently opened a position in HIMS and HERS because I think the risk and reward is just overly strong in that reward range. So for me, it makes sense to have that position to take that bet, so to say. So yeah, let me know what you think about HIMS and HERS in the comments, and let me know also about other stocks you might want me to cover, you might want me to talk about in the earlier, in the upcoming videos. So yeah, have a good week and see you next time.